and I'm not going to get too much into the law of compounding interest and how that works and why the tortoise wins the race over the hare, but it's something definitely to look at. So one of the great things about private mortgage lending is that you can invest in real estate and let someone else do all the work. So you get to act as the bank and determine the terms and the property types that you want to lend on. You set the rate, whatever that you and your borrower agree upon. And as long as that, if you've analyzed your borrower properly, you can sit back and just watch it grow every single month. If you're looking to invest in a self-directed IRA, I suspect some people watching this have heard that you can invest in mortgages as a self-directed IRA investor. You absolutely can. And there's less liability than owning that real estate yourself or in your IRA. And that's what I personally do, just so you know, is I've got an IRA for myself, my wife, and my children. But what we do is, rather than investing in property, we invest as a lender. It's just simpler, it's cleaner, there's less red tape with the IRS. When done properly, private mortgage lending can be an extremely low maintenance asset. What do I mean by that? So typically whenever we do a deal, I'll send out an email blast. There'll be some emails, maybe some phone calls exchanged between myself and my lender. We basically, like I said, either email a lot of times, phone calls and texts. We basically establish our loan agreements, rates, terms, et cetera, and all that is communicated to my real estate attorney and to the title company, and the loans are processed, and we move forward at a closing. And then after that, they get a check in the mail every single month, or via ACH, and don't really hear back from us too often unless they request updates or whenever the loan is paying off and they're getting their capital back. And you can also partner and combine funds with other investors, family and friends, and other people like that. So that's pretty cool as well. Okay, so be the bank, establishing your guidelines. So what are the guidelines that you're going to want to establish? So I'm going to let you take a look at this here, and I'm going to grab a drink of water. Okay, so be the bank and establish your guidelines. So what are the things that you're going to want to have clarity on? So you're going to be the bank, establishing your guidelines. The loan amount, of course. What is the loan amount? What is the interest rate? What's the length of term? Is it 6 months? Is it 6 years? We've done loans as short as 6 months with our lenders. We've done as long as 10 years. Is there an amortization schedule or prepayment penalties, or is it interest only? Equity participation, that's what we do with some of our lenders. Some of our VIP lenders, I will say that we have a much more established long-term relationship, and we actually will provide a lower interest, say for example 4% interest, but we will give them, say, 30 or 40% equity and net profit in the deal, depending on the deal and depending on our agreement. And then when's the payment due? All right, what's the delivery address? Where are you going to get paid at? I will tell you that don't concern yourself too much with these all these items that we're covering right now. Even along with prepayment penalties, late penalties, personal guarantees, draw schedules, first liens only. These are things that, number one, any experienced borrower should already have kind of these outlined on what their, kind of procedures and policies are. And number two, a good real estate attorney will help you with. And for some of you, if you're watching this and feeling overwhelmed, like, Brant, you're going too fast, slow down. I can't because I'm on a time crunch. But once again, this is not really a shameless plug, but a little bit of a plug about my book, The Private Lender Playbook. But if you don't want to buy it, whatever, it's not very expensive. But if you don't want to buy it, if you email me or if you go to privatelenderplaybook.com, there's a sample of a free copy or you just message me, and I will send you a free copy, electronic copy. I'm not going to send print copies. You got to buy those. But I will send you a PDF copy of this if you just reach out to me. Okay, so here we are moving forward. So let's look at this. This is a question that comes up: is why would a borrower even use a private lender? Why don't they just go to a bank? Well, one of the main reasons is they need a quick close. The banks are kind of like the government. They don't do anything quick. They don't do anything quick. So a lot of deals that we buy, we do marketing for motivated sellers, right? So depending on the situation, a lot of times these sellers want to close like really quick, like yesterday. So we've got to close quick, sometimes in as little as 3 or 4 days. So that's one of the big reasons. The borrowers, if it's a short fix and flip deal, we've done some deals in 45, 60 days from start to finish. A bank is not going to go through a process and issue a loan for 45 or 60 days. That's how long they typically take to even write a loan. So that's another reason. Let's be honest here. So a lot of real estate investors, they may have weak credit or income or the documentation of both. So when I got started, like I said, I had excellent credit. I've never, defaulted or missed a payment on anything in my life. But when I was getting started as a real estate investor, I could document my work income, and that's about all I had. But, banks were not going to approve me to buy a real estate deal unless I was going to put down, 20%. And I just didn't have it at the time. So you may be asking yourself, well, Brant, should I be loaning to an investor if they're not putting money down on a deal? Well, it depends. You need to expand your knowledge base. Depends on that particular deal, depends on that particular borrower. I will tell you that we receive 100% financing from our lenders on our deals, but I will also tell you that we typically have 25 to 35% equity in all of our deals that we're buying. So there's kind of some built-in equity, but there's also, like I said, a good amount of trust that we have with our lenders. So you may require them to bring capital and put money down, and I don't fault you for that. So this is just some of the questions you have to navigate through. So, the next thing is construction and bank loans simply do not make sense. I've utilized, we utilize a ton of bank loans. I'm going through a process right now of refinancing 5 properties, refinancing from my private lender capital to long-term bank financing. So we do this all the time. That's a slow process. Realize that we always, and I say always, we buy these properties with private money and then refinance to long-term bank loans. We don't buy them in bank loans to beginning because of the time factor. Number 2, construction loans. I've been through that process of utilizing construction loans. But even when I did that, we bought with private money, paid a little bit higher interest, and then essentially refinanced to a construction loan. So there's a lot of factors here. And just to be honest, using private lenders, it's a much simpler process too. The paperwork and all that type of stuff is much easier. Not that we don't provide our lenders all the required documentation. We always close at a title company. We use a real estate attorney, but there's just less red tape than dealing with a bank. And the other reason that real estate investors use a private lender is just more cost effective and efficient than hard money loans. Now, hard money loans definitely serve a place in our marketplace, but private lending has filled the gaps between banks and hard money lenders.